Hello and welcome to the week ahead with me, Fiona Cincotta, Senior Market Analyst at City Index, as we look ahead to the first week in February. So I'm just going to pop on the risk warning. I will ask you to read through it. I'm going to pop myself on mute. Okay, so without further ado, let's crack on and just start by taking a quick look at what's been going on this week, because there certainly has been plenty going on, although that's probably not so evident in the S&P 500, but yes, more so if we have a look at the US dollar or indeed precious metals. So, but just as far as what's been happening this week is concerned, we are seeing US stocks are actually on track to book weekly gains, despite this sort of increased volatility that we've seen, particularly around the FX and precious metal markets, and as sort of investors have digested the latest Federal Reserve interest rate decision, geopolitical tensions, the start of mega cap earnings, and immense volatility, as I said, in certain markets. So just a quick reminder, the Fed left rates unchanged at 3.5 3.75%, although the Fed also highlighted solid growth outlook for the US and a sort of and a stabilization in the labor market, basically suggesting that interest rates are likely to stay on hold for longer in the US. Now, interestingly, we still saw the US dollar tank to a 4-year low on the day before the Federal Reserve interest rate decision, and also just around there. And this was due to a couple of reasons. We saw seeing that continued sort of sell America trade amid concerns over Trump's trade tariff threats. He threatened 100% tariffs on Canada. He also threatened or was lifting tariffs on South Korea. Then at the same time, we also saw geopolitical tensions rise with Iran, which usually, again, we see the US dollar behaving as a safe haven, but it's just not behaving as a safe haven in these instances, as if the market very concerned about the policies coming out of the US. So that dollar has slumped to a 4-year low. We have seen it pick up slightly, but not particularly. I mean, it's not a major move that we've seen at all. We're sort of just back towards that support level around the 96 level, acting as a resistance. We're just sort of above that now, and that just seems to be pulling the RSI out of overbought territory. Now, with this volatility that we've seen in the US dollar, as I mentioned, we've also seen a similar level of volatility in gold. This is gold. We can see this massive run higher before dropping sharply, and then also in silver as well. Again, huge run higher. I mean, it was up around 65% just this month before dropping huge amounts in potentially the biggest one-day swing in the metals market that we've ever seen. So that's something that we're also watching, and that these big moves have come again amidst a backdrop of challenges, safe haven demand, concerns over the US policy, the debasement trade, concerns over the sell-off in the US dollar, and look for the desire for hard assets. But we also saw this sell-off, massive sell-off, as the market priced in the Trump announcing Kevin Warsh, the federal governor, ex-federal governor, as the next Federal Reserve chair to replace Powell in May. And that sparked quite a reaction in the metals market. And then we also, we'll come back to all of this shortly, but just giving a quick roundup of what happened. Then we also had results from Microsoft, which tumbled 10%. Basically, that's on concerns over the increased and massive capital expenditure on AI without seeing the results to support the monetization of it. Different to Meta, as you can see, massive jump higher on optimism surrounding those levels, even the outlook guidance, even though we saw CapEx expenditure increasing significantly. So that's sort of what's been going on. Just want to spend a quick moment talking about the Federal Reserve Chair Kevin Walsh. And he's been selected. It has just been announced just before doing this webinar. Basically, he is actually expected to take a slightly more, or has been previously, a slightly more hawkish sounding Fed member. He was governor, I think, 2006, 2011. And so he does have a reputation behind him for being more hawkish. However, more recently, his commentary has been more aligned with Trump, suggesting a slightly more dovish outlook. But I think, broadly speaking, he is expected to be on the more hawkish side, which could mean that we will see fewer rate cuts. Now, obviously, this is quite in the opposite direction to what the market had been expecting, with expectations that Trump would implement or would announce a much more dovish Fed chair, particularly since that he's been so critical of Jerome Powell for not cutting interest rates fast enough. So that's what the market's going to be watching out for. The market's also going to be waiting really to see what this does actually mean. But I think we're just seeing that repricing. We've seen Treasury yields tick higher yesterday. We saw the US dollar recover slightly from that 4-year low. We saw massive swings in gold and silver. And I think there's also a bit more trust in Kevin Walsh as a Federal Reserve, more experienced than potentially the other nominees that were shortlisted, which may reduce the need for safe haven assets slightly, which is why we've seen that sort of pullback in what was a very frothy market as far as gold and silver are concerned. Just having a look here at levels, this is the silver market that we're watching here. Key level, I'm sorry, this is the gold market, sorry, that we're watching here. That we're back above the 5,100, 5,100 level. We did spike lower to that 5,000 level. Very long lower wick on that, so it does suggest that there was literally selling demand at those lower levels, but also we've got a very long and higher wick on that candle there, which suggests that there was little demand at those higher levels as well. So we're very much just sort of trading now in some consolidation mode, bringing this RSI out of overbought territory because it was massively overbought and had been for quite a sustained period of time, a couple of months back there. Gold often moves out of that sort of overbought scenario, which is why we've seen this move lower, and now potentially a consolidation whilst the market just really gets to grips with all the headlines that it's been having to deal with. So as far as levels to be watching on the downside, I think that 5,000 is obviously a key level on the downside. On the upside, the key level there's 5,400. If we get a rise above that, then you've got the 5,475, which is the fib extension from the 30th of July low to the 21st of October high, with the pullback there to 28th of October. So that's the gold that we've just been looking at there. The other one I'm just going to pull up now is we've got quite a lot going on next week as far as central banks are concerned. So we're just going to pull up here sterling US dollar. sterling US dollar did again rise to this level here, which is a multi-year high. If we just pull out onto the weekly chart, we can see that that was a level that was last seen back in 2021. Basically, very much a US dollar weakness story that we talked about as the dollar dropped to that 4-year low. We saw currencies across the board pushing higher. Now, what to expect from the Bank of England next week? Bank of England is not expected to cut interest rates. Expected to leave them on hold at 3.75%. That was after the Bank of England cut rates by 25 basis points to 3.75. Oh, sorry, I don't know what happened there. Yeah, so that was as the Bank of England cut rates by 25 basis points to 3.75% in the December meeting. Now, if we remember back, that was actually quite a narrow vote split of 5-4, and guidance remained cautiously dovish, but noting that how inflation had probably peaked and was expected to cool to 2% target by the spring. Yeah, and there was sort of an alluding towards softer data, but the Bank of England was also cautious about how quickly it would be cutting interest rates going forward. Still, I think that softer outlook for the economy has been sort of highlighted in recent data. Unemployment rate is still at 5.1%, and that's the highest level since May 2021. Core inflation also down at 3.2%. That's the lowest level since December 2024. So, I mean, the Bank of England is still expected to keep rates on hold for this time being and for the rest of this quarter, just so it can see the impact of the rate cutting cycle on the economic data before taking further decisions. But if we do see this continued softening of the labour market particularly, but also of cooling in inflation, then obviously that will help the Bank of England move to cut rates faster. A stronger pound to the US dollar, as we're seeing, is also would also help to reduce inflationary pressures. But for now, we're not expecting the Bank of England to move on rates. As far as the pound US dollar is concerned, this is the 138 level. We're just below it now. We did rise up to a peak there of 138.70, but listen, that was pretty much a sharp move higher, very sharp move higher. And we're just seeing the 50 SMA crossing above the 200 SMA here. This is a bullish signal. Now, if we do see, but we are overbought, so reasons to be cautious, reason that we could see a little bit of consolidation. But if we see a more hawkish sounding Bank of England, then potentially if we see this continued sort of weakness surrounding the US dollar, then we could see this pair push higher up towards the 140 level. Obviously, a dovish sounding Bank of England, concerns over the labour market, that could bring on the downside the 137 level back into focus ahead of the level down here at 136 before we get towards the 135.50 level. So, but as I said, quite a sharp move higher that we've seen. It would take quite a lot for the near-term outlook to negate that uptrend. Other one I'm just going to take a look at is the FTSE, because obviously the FTSE has been well supported, reaching a fresh record high this week despite all this volatility that we've seen across the market. I'm just going to move into the 4-hour chart because I think it's a bit clearer what's happening. Here we go. Just trying to break out of this falling trend line here. Still the recent uptrend is very much in place. FTSE miners, they've been outperforming apart from the sell-off yesterday, which we can see the spike lower here, but they're recovering again today. The FTSE very much minor driven, given those impressive gains that we've seen across precious metals, impressive gains that we've seen in copper, which also reached a record high. So, you know, lots of mining gains in focus there. Obviously, banks are going to be in focus with next week with the Bank of England interest rate decision. Also, bank earnings will be coming up soon. And also, we've got energy, oil majors have been outperforming. And that's basically because of these gains that we've been seeing in oil. As we've seen Trump ramp up, escalated tensions with Iran, the fourth largest OPEC member. So just as far as the FTSE is concerned, if we do see a break above that falling trend line, we're looking towards the 10-250 level before pushing on to 10-280 for fresh record highs. On the lower side, this is a key level here, 10-160, that's the 50 SMA and the rising trend line support. So as far as central banks are concerned, we've also got the ECB. So ECB isn't really expecting to be a very exciting meeting, and that's basically because we've got inflation in the region at 1.9%. So that was just downwardly revised from the 2% target level in December, and it was 2.2% in October and November. Now, the rise in the euro against the US dollar is likely to have played a role in easing inflationary pressures. It's risen by about 10% against the US dollar across the past year. That means that we're not expecting the ECB to cut rates at this meeting or at any meeting this year. We have had a couple of ECB policymakers this week saying they're slightly concerned regarding that stronger euro, but it depends whether it's going to be sustained as a stronger euro or not. A euro that's sustained above that 120 level could add deflationary pressures and could mean that the ECB will need to cut interest rates again. We're not there at the moment, but it is something that is being talked about. Just as far as the technicals go here, we've seen that recovery from the 200 SMA bouncing up to this high, multi-year high of 120.82 before just easing lower. Now, a key level to be watching here is that 118 level on the downside, just pulling the RSI out of overbought territory. So the uptrend is still very much in focus. A rise above that 120.60 is going to be bringing this level in here, which was a level that was last seen in 2021, the high that we saw in May 2021. So that's going to be in focus as far as the euro is concerned. Just having a look what all this means for the DAX. Now, the DAX has had a little bit of a struggle, obviously to do with the volatility that we've seen across indices, global indices, because of concerns regarding concerns regarding sort of the US position, the change of the helm at the Federal Reserve, but also those earnings that we saw this week with Microsoft really disappointing. And as a result, we saw SAP, which is a huge German company, falling very, very much lower on those tech fears. So that's something else to be watching out for. Just having a look here, this is the DAX. We have seen it find some support on the 50 SMA there, which is interesting and important as we head into the weekend, that support is holding. And buyers will need to get a recovery above the 24,680 level, which is the level that's been important across several moments across the past 6 months. And then also this level here is looking important, 25,000 basically. Another rise above 25,000 will also then bring the record high of 25,500 into focus. As if we do get a close below that 50 SMA, then that's going to bring this level here, which is that rising trend line, which dates back to the April low and is also the 200 SMA, that region, that support at around the 24,150 and the 200 SMA, which is at 24,000. So that would be the next level to watch. If we get a break below that, then things could turn quite significantly more bearish, looking towards the 23,380, a level that was offered support on notable occasions across the past year. So that's the ECB. And then as we continue with our rate decisions and what's going on, this is almost a joke, isn't it, with how much the Aussie dollar has run over. I mean, in December, look, the low in December was down at 65, 66, and now we're up at almost 71 as that peak. And just to sort of put that into perspective about what that means with when we last saw that sort of level was back in January 2023. So just as far as what to expect from the Aussie dollar, this is really interesting because the Aussie dollar has performed significantly well, despite the it being considered a risk on a risky currency. So, you know, often if we've got sort of golds and silvers and safe havens running higher, we wouldn't really expect to see the Aussie running higher as well. But yes, we have. So that does tell us that there does feel like there's a little bit of a lack of or changes in dynamics across the rest of the broader market. So as far as the API is concerned, as far as the RBA is concerned, they are potentially looking to hike rates. Now, interestingly, in December, the RBA left rates unchanged at 3.6%, and that was in line with expectations and also a third consecutive hold. And that was despite October's CPI report showing a rise in both headline and underlying inflation. Now, interestingly, during that press conference, Bullock confirmed, that's the governor, confirmed that the RBA did not consider a rate cut to be considered, but they did consider scenarios for a rate hike. And that means that, you know, the market suddenly understood that the central bank was more hawkish than previously. And since that meeting, we've also had several stronger data points come in, with unemployment falling to 4.1% and inflation rising to 3.4%. So that's up ahead of even expectations by the RBA of a 3.2% increase. Now, the market's pricing in a 75% probability of a rate hike in this coming meeting. That would take rates to 3.85%. So this is interesting because obviously we've got the RBA hiking whilst you've got the Fed considering rate cuts, which is what is driving this pair significantly higher. Levels to be watched on the upside. Buyers are going to need to get above that 170.90 level in order to create a higher high. Obviously, we're still pretty overbought here, so we could still see some further consolidation before any moves higher, but a move above there would bring a higher into place, opening the door to 272. Just immediate support there is the 69.76 level. That's sort of the recent lows in recent sessions, but those longer sort of lower candle wicks suggest that there's little selling demand at those lower levels. But you know, really it would take a move below this one here, 67.50-40, to negate that up-term trend, which really has been quite steep. Another thing to be looking at is going to be oil, because in addition to all the factors as far as earnings and central banks are concerned, we actually also have the geopolitical tensions, which have been very much in focus as Trump sends the Armada, as he calls it, to the Middle East, and has threatened Iran that time is running out for a nuclear deal. these comments and threats and actions has resulted in a massive breakout in oil prices, which have risen to their highest level in 4 months, and booked strong gains across the board despite the volatility that we've seen elsewhere. So we saw prices rise to that 65 level, well, no, 66.50 even, which was the same high that we saw back in September. We've pulled away a little bit from that level. We're testing 65 at the moment, but the big concern here is that obviously if there is any military action in Iran produces around 3.3 billion barrels per day of oil, exports from those 1.5 million, sorry, million, not billion. So, you know, it's a key supplier. If there is any sense that supply could be impacted, then that would be weighing on the supply outlook, boosting prices. Also, the weak US dollar has been making commodities that are denominated in US dollars, such as oil, gold, silver, much stronger because it makes them cheaper for buyers of foreign currencies, which again has added into that rally that we've seen. If we do see a de-escalation of the situation, that does mean that the market might then start focusing on the fundamental factors which are actually more bearish, such as oversupply, bringing prices back to 62.50. That's 200 SMA. It's also the level that we saw back here in October, and a break below that brings 60, the round number, back into play. If we get a rise above here on the upside, then it's going to bring 70 in as the next level to be watching. Didn't really get a chance to touch on it by too much, but earnings also, we've got more earnings coming through from the US, which includes Amazon, which includes Alphabet, which includes Planeteer, which includes Disney, AMD, Uber, Amazon, Qualcomm. So earnings season continues to ramp up. This is the S&P 500. I think what I would be a bit concerned about here is the fact that we're seeing momentum slow fairly considerably. So momentum slowing whilst we've got sort of the rise going on, which suggests we could see that sort of that receding bearish divergence can be a signal that we might start to see prices fall lower. Not happening yet. We've just got the fresh record high that we saw this week of over 7,000. Obviously, we saw a lot of volatility yesterday, picked up from those lower levels, so it really did find support on that rising trend line and also the 50 SMA. Those long lower wicks suggest there's little selling demand at the lower levels, which could mean that a rise above 7,000 is on its way. This is the Nasdaq. Obviously, AI spending is a complete concern, especially if the results aren't top quality, which is what the market worried about with Microsoft, but was pleased as far as Meta was concerned. Again, this is the Nasdaq. We had rallied to fresh record high, almost, not quite, 26,220, before falling sharply, finding support on that 50 SMA. So that 50 SMA there at 25,400 is pretty key. Again, we've seen some volatility, say long lower wick, needing to push above the 25,835. Above here, we got 26,000 and on to record highs. On the downside, the 50 SMA there is pretty key at 25,400. And below that, you've got this 25,180, which complements the rising trend line and the horizontal support. That is everything I will be watching next week. And yeah, I look forward to seeing you next week.